You can follow every piece of financial advice and still feel stuck, like you're not making progress. You can earn more, save consistently, invest early, and still feel like nothing is changing. I started from the bottom, doing basic jobs, and eventually built companies worth billions and managed serious capital. And what I realized along the way is this: money doesn't operate on rules, it operates on laws. So in this video, I'm going to break down the 7 laws that actually control how money works. Think of this as a system built on 3 key forces: momentum, structure, and asymmetry. Momentum is about how fast your money can start growing. Structure is about who's in control and who benefits. And asymmetry is about making sure your upside is bigger than your downside. Let's start with the first law. Money moves fast, but wealth grows slow. When I first entered real estate, I focused on flipping properties. I would find deals, fix them up, and sell them quickly. I repeated this process again and again for years. During that same time, a friend of mine took a completely different path. He bought a single property and held on to it. Later, he expanded into a small multi-unit property. Then eventually, he scaled into a much larger building. He didn't chase quick wins. He focused on long-term growth. After 5 years, I had done dozens of deals and made money, but he owned assets that kept growing in value. His net worth ended up far ahead because he played the long game. So what does that mean? What is speed and what is time? Speed is how quickly you act when you see an opportunity. It's the gap between recognizing something and actually doing something about it. The smaller that gap, the faster money moves. Time, on the other hand, is about patience. It's about making a solid decision and letting it grow over years. At first, it might look like nothing is happening, but eventually the results become obvious. Most people confuse being fast with getting results fast, but those are 2 very different things. You need both fast action and long patience. One of the best examples of this is long-term investing, buying strong assets and holding them for decades. Over time, those decisions compound into massive results. This is why time is your greatest advantage in building wealth. And once you understand that, the next question becomes, who benefits from that time? Because in money, the one who provides the capital usually controls the outcome. That leads to the second law. The one who funds the deal holds the power. Over the years, I've been involved in multiple business exits, and in almost every case, the buyers ended up making far more than the sellers, because ownership and control create leverage. If you look at the wealthiest individuals, you'll notice a pattern. Very few got there through salaries alone. Some made it by selling businesses, but most built their wealth by continuously buying and growing assets. They don't just earn, they acquire and expand. That's where real power comes from. Without buyers, markets don't exist. Buyers create value by putting money into opportunities, and because they provide the capital, they set the terms. The key takeaway is simple. Ownership shifts the game in your favor. And when you step into that role, you start thinking differently. You stop asking how to earn more and start asking how to own more. But there's another layer to this. The biggest players don't just use money, they use leverage. Which brings us to law number 3. Leverage multiplies everything. Leverage allows you to control more with less. Instead of using only your own money, you use other people's money strategically. This can dramatically increase your returns. The same principle applies across businesses, real estate, and investments. It's one of the most powerful tools in finance. But it has to be used correctly, because leverage doesn't create success, it amplifies it. If your foundation is weak, it magnifies the downside too. That's why understanding leverage is critical. Now, even with leverage, there's something more important to understand: the difference between income and ownership. Law number 4, income sustains you, ownership frees you. Income is what covers your daily life. It keeps everything running. But ownership is what builds long-term wealth. It's what gives you freedom. The best way to build that is through equity, either in your own business or in someone else's, because equity grows over time, and that growth is what separates rich from wealthy. Now, here's where things get interesting. Most people think risk and reward move together, but that's not true. Law number 5, risk and reward are not equal. In reality, a few big wins drive most outcomes. Many investments fail, but a small number generate massive returns. That's the game. Your job isn't to win every time, it's to position yourself for asymmetrical outcomes, where the upside is huge and the downside is limited. But to play that game, you need discipline, which brings us to law number 6. Don't risk everything for one opportunity. One bad decision can undo years of progress. It's not about how good the deal looks, it's about how much you're risking. Smart investors protect their base first. They survive long enough to win big later, because staying in the game is more important than winning once. And finally, the last law ties everything together. Law number 7, diversify when you don't understand. If you deeply understand something, you can focus on it, but if you don't, spreading risk protects you. The problem is most people diversify without thinking, instead of understanding what they invest in. The real advantage comes from clarity, knowing what you own and why you own it. That's how real wealth is built. Now, understanding these laws is powerful, but applying them is what actually changes your life. Before making any investment, ask yourself 5 questions. Can this grow over time? Who controls the outcome? What happens if it fails? Is the upside worth the risk? And do I truly understand it? Because at the end of the day, wealth isn't about luck. It's about decisions. And the better your decisions, the better your outcomes.